All right, welcome in everyone. I believe the meeting is live streamed. This is the Investing Power Hour number 76 on Chit Chat Money. My name is Brett Schafer, and I'm joined as always by Ryan Henderson. Today on these episodes, which again we do live, but can also be are also recorded and are available on any podcast player of choice on Sunday mornings. These go live on Thursdays. So if you want to join, ask us questions, head on over to the YouTube channel. Ryan, how are you doing? You got stuck in about 2 hours of traffic this morning, but it looks like you have some fun topics for us. We're gonna
Yeah, it really kerfuffled me. I was unable to focus, very, very infuriated. I felt like Dennis in Always Sunny in Philadelphia, just screaming at traffic.
that
But
episode is very it's very in touch with when you get stuck in traffic. You turn into a psychopath, but
yeah,
or at least not just you, everyone. The Yeah, we're outside of earnings season right now, but it seems like there's a lot to talk about. We have the Disney charter stuff. We had some Amazon news, maybe. I'd maybe like to talk about that. You have a couple anecdotes, and we're doing our rankings of worst acquisitions of all time. Can we maybe change that to dumbest acquisitions? I guess
fine
that
by
could be
me.
the same thing, but I would like to do basically where the rationale didn't make sense at all.
Yeah, I'm okay with that. We can do that because I don't know. Sometimes when we do like these worst acquisitions of all time, it's easy to just say like which ones went to zero or like
And
best
yeah,
acquisitions. You could just be like, oh, double click
YouTube,
from
yeah,
yeah.
YouTube, Instagram, yeah, of course. Yeah, I don't really have anything else. I guess the new iPhone came out, which really isn't much news. There wasn't anything new there, like when they launched the Vision Pro. I guess, yeah. Why don't we get started, Ryan? I'll tweet out the link and say what we're going to be doing here. And yeah, what's your first topic? It looks like you have Instacart, which is pricing their IPO. And then we also have ARM, which we don't really know much about, but it seems to be pricing at a very expensive valuation that SoftBank is trying to really, really get over the line here.
Yeah, the SoftBank one doesn't make a whole lot of, or the ARM one makes less sense to me. But the Instacart valuation or what they're targeting as their most recent IPO is like, I think it's a $26 to $28 share price, which comes out to a range of like 8.7 to 9.3 billion in terms of market cap. But I don't know. Apparently, it's a little complicated because a lot of the insiders are selling, so it's not going to the corporate balance sheet, and I don't know, it just isn't totally clear what the fully diluted market cap is going to look like. So, assuming a $9 billion valuation, that would put Instacart at 22 times operating income, which doesn't seem too crazy to me. And that's GAAP operating income, so it's encapsulating stock-based comp there. It's actually it would trade at like 15 times net income, but there was this one-time tax benefit last year that isn't going to be there on a normalized basis. And so it feels like we have kind of a rational IPO market. And to be honest, I mean, I looked at Instacart and we kind of had differing views on the value proposition. I think you kind of called it crazy that people use this stuff, but um, I think it's a pretty good business. And I know a lot of people that use it. It's kind of convenient for the average for the busy parent, that kind of thing. So I think they have upside, but certainly it's come in a little bit just with people not wanting to spend as much money on delivery of these kind of things. So growth has certainly slowed, but I think 22 times operating income for a business where my thought here is that online grocery spend will grow over time. It feels a lot like the other marketplaces where, with with whether it's DoorDash, whether it's Airbnb, Uber, a lot of it is just proof of concepts or proof of people using it and then having the validation that, oh, okay, this works. It's a process that I can get used to. I think that kind of takes over time. And for me, it looks kind of attractive.
Yeah, I will comment on that, but I will say we have Julius Caesar back today in the comments. So thank you for time traveling and visiting us today. And we had a good comment from Tyler saying that all 5 of the worst acquisitions are going to belong to Square, which I
I
actually
don't
might
know.
just do all.
Prime eBay might be worse.
That's true. That's true. If you look at the history of that, but let's not spoil any of our picks and let anyone steal others. So I think I kind of know what Ryan's is going to be as I was doing some research as well. But yeah, when I look at Instacart, I think that valuation makes sense. 22 times I think is saying basically, okay, this isn't the. I think it's showing that a lot of other investors have my concerns, which maybe is an opportunity there if you're more optimistic, like Ryan is. But here's one thing. I did a look. I wrote a Motley Fool article on them, so I only read a little bit of the S1. But the one thing that concerns me, maybe I'll just pull up the article so I get the numbers right, is that the advertising, or excuse me, a lot of the revenue growth over the last, looks like it hasn't been published yet. Well, okay, well, it'll be published, but a lot of their growth over the last year and a half has really been from the advertising division. And I think that opens them up. It's not all of it, but a lot of the growth, especially a lot of the gross profit growth, has come from the advertising division, which again, it's not entirely advertising, but I would say is most likely almost all advertising. And this could be, promotions, whatever. It depends how you define advertising. I don't know how healthy of growth that is compared to I worry that it might open themselves up from competition from Uber and DoorDash, basically opening it up and saying, hey, look, we're getting a higher margin from our customers here. Maybe they're going to go and compete in the marketplace. But, these marketplaces are decent businesses. It would be pretty hard to compete with Instacart going forward if you wanted to start from scratch the same sort of business model. And I wonder if the market of them, Uber, and DoorDash will get rational, but I think it's a big TBD on that front. What do you think?
I think it's gonna be harder for people to move. I don't know. People keep having these worries that like, oh, Uber will get into that if it's anything marketplace related. I think it's way
They
harder
are
for
in it.
Yeah, but Instacart's the leader. And I think Instacart's gonna grow its lead. Lyft was in the same market as Uber. I think the big names in their specific markets, food delivery, DoorDash, Uber, ride sharing, grocery delivery, Instacart, will continue to be the leaders just from the name notoriety. Like when people think I
Yeah.
want my groceries delivered, I think the first thing people go to is Instacart.
Yeah. And look, that sort of makes sense, but let me try to find a chart here of, let's see. Yeah. Okay. Well, if we look at, I can't find a good chart here going back to like 2015, but the food delivery shifted the dominant market player, quite drastically. I mean, Grubhub used to be the leader, and then DoorDash came in, flooded the market with money. Yeah, SoftBank might be a part of that because they just gave everyone billions of dollars, both Uber and DoorDash. And now it's flipped, and DoorDash dominates the market, and Uber Eats is second, and Grubhub is a distant third. So I don't, I wouldn't count out DoorDash and Uber here because, yeah, Instacart definitely has the lead, but it seems like DoorDash is doing really, really well with grocery, although we don't have very granular data on that.
Could be. Yeah, it could be. Maybe that's part of the reason for the slowdown. They didn't really talk that much about, and I was looking at the revenue year over year. Transaction revenue is still growing. I think it was 13% year over year, if I'm not mistaken, in the most recent quarter. And advertising was growing at like 20%. So it's off of a smaller base. So I think nominally transaction revenue is probably still growing about on par with advertising. It uh, that might be a reason for part of the slowdown. The only thing that really concerns me, and I needed to find some evidence to support this. I had a feeling most IPO returns end up quite poor, but I wasn't 100% sure, so I wanted to confirm my bias. I found this chart. I don't know. Can I share my screen?
Oh, let me give you access. Boom. All right.
And I'm sure the listeners just hate it when I say that, but the here's the distribution of IPO returns post IPO. And so after 3 years, 64% of IPOs are
Down 10% or
down
more,
10%. I don't know if that's relative
or
to the
versus the
index, but
index, or still, I mean, yeah, underperforming.
29% are greater than 10% return. So maybe this wasn't quite as bad as I was expecting, I guess, but it just feels like you're at risk to lose a lot of money when investing in any of these things. Like I'm sure some of these were, and I bet following 2021, it's going to distort some of these numbers because it's going to be like
Make it look worse.
90%
Yeah.
if they include SPACs. I don't know. History just says to wait.
Yeah,
I always get attracted to some IPOs. I'm always the guy that says don't buy IPOs, and then there's like that one IPO in my wheelhouse. And I'm like, oh, you know what? Maybe. And it's like just don't do it.
I don't know if Instacart's the one. Seems like they got a good executive over from Facebook though, or Meta. But yeah, I think a big example here is we've kind of utilized it with another company that went public in 2021. We're like, hey, valuation's a bit crazy here. We like this business. We think it has some promise. Let's wait 2 years. And the base rate would say, or kind of, I don't know if it's base rate, but basically if you look at the historical average, you'd say, all right, the stock is probably going to be down. And if you like the business and you think it has promise, the stock could probably be down after its IPO, and the business could be doing just fine. And that's what happened with us. And that's why we think of an opportunity with one of those companies. The same could happen with Instacart. And if the business continues to grow its earnings, and the more it grows, which is nice about these marketplaces, as you're obviously well aware of, Ryan, the more the wider their competitive advantage grows, they could be trading at a pretty discounted valuation if the scenario plays out. So maybe the opportunity is there, but yeah, IPOs generally, I think you gotta exude some patience there.
You know who could be that one outlier? Birkenstock. They just filed their F1. Here's the first sentence of, I think, after the CEO
they're
letter.
Foreign? They're European?
Yeah. It says, we are serving a primal need of all human beings.
All right, boom, I'm in. Don't say
we are a footbed company
more.
selling the experience of walking as intended by nature.
Yeah,
this is only the beginning.
That is perfection right there. I would say that is going to have a premium valuation, and I'm never going to touch it because any sort of fashion and apparel is, I mean, we've looked at so many of those companies, and it's so unpredictable. Yeah, there's a few brands out there that have stood the test of time. Maybe Birkenstock is one of them, but man, it's such a tough industry, and I get so nervous looking at all these companies.
Hey, if it's anything like Crocs,
it's going to have the most insanely volatile stock out there.
Hey, Crocs has been a massive outperformer over the years.
I know.
I wonder
the last 10 years, right?
I wonder if this thing's profitable.
Birkenstock, 100. It's got to be. If it's not, I'd be shocked. Crocs is actually down too this year. Maybe it's time to take a look at it again. We had an interview with our friend Jacob Franklin discussing Crocs. If anyone wants to take a look at that, I believe that was like 2 months ago. But yeah, Ryan, do you get the numbers? Are they profitable?
Adjusted EBITDA margins, the first thing I'm seeing, 35%. So I'm assuming,
unless they're granting 30% SBC as percentage of revenue.
Yeah, they're man, they got all these like predecessor, successor income statement stuff. Makes it a little complicated. 6 months ending March 31st, so the first 6 months of this year, operating income was 118 million on $644 million in revenue.
And what's the value? I hear the valuation is going to be $8 billion.
That would be crazy.
The market cap. Yeah, that's what I heard.
It's like 80 times earnings.
Well, what was that 118 million for this year or 6 months?
Yeah, but they have a ton of interest expense, it looks like.
Well, hopefully they raise some money and pay down that debt. Well, I hate talking about this type of stuff when I haven't read the S1. Maybe, it could be a fun theme to do a bunch of S1s. We could do Instacart. We could do Birkenstock. We could do Turo. and we could do ARM. That could be a fun month.
I don't
But
want to do ARM.
yeah, that's actually way too hard. It's like, all right, we had this. Yeah, it's impossible to figure out.
We could do
Okay.
a theme of most egregious S1s or like most egregious TAMs.
Yeah, that could be a fun one. Okay, we have a comment here from Tyler. Oh, what did I type there? Says a successful advertising scheme is hard to run. It's interesting that Instacart seems to have built one. Grocery shelf space charges being a good analogy to carts advertising, meaning Instacart. I think that makes sense. Yeah, like charging for shelf space. I think another example, which when we looked at Uber, we thought was probably the most bullish opportunity for them is promotions for the Uber Eats offering, which could also lead into their grocery stuff as well. Yeah, it seems like a very rational opportunity, very similar to Amazon. You just copy that sort of model. Makes a lot of sense. But the big concern in that industry, maybe as we wrap things up for me, is that DoorDash is crazy. That's honestly my biggest concern.
Could be.
I mean,
If you think
have you ever
about,
listened to them? They're crazy. They think they're going to disrupt Amazon.
no, I really admittedly have not paid that much attention to them, but what was I going to say? If you think about it from a brand's perspective, like, I don't know, Pepsi or something like that, if you can target someone at the point of the transaction when they're ordering stuff, it seems like a very valuable digital real estate, as as a place to kind of market to, especially if you
Oh
can
yeah,
get insights on like if they've added 2 bags of chips or a bag of chips to their cart, promote Pepsi, that kind of thing. It feels like just kind of a great place to be. But
yeah.
so I'm
I
not
mean,
surprised it does well.
yeah, and this is not. This would probably be different than the food delivery business, where I would say it's like I would worry that the business model is not that sustainable because eventually the prices they're going to have to pay these delivery workers and the prices that restaurants are going to want to, the margins don't make sense across the board sometimes with that business. But with grocery delivery, it seems like it could make a lot of sense. We have Andrew Marshall in the house. Thank you for joining again. We just had a nice call with them over at Capital Mindset. Speaking of grocery, we talked about Sprouts Farmers Market, which will be up on their YouTube channel at some point in the near future. So we'll point anyone to that. So again, yeah, I don't know. We got some other comments in here.
Did
Anything
you
else on Instacart or
No.
Ryan?
Did you see this headline that Disney CEO Bob Iger wouldn't give up his office to Bob Chapek because he loved the shower so much?
Yeah, he's, there's a few people out there that I used to admire a lot, and I've learned a lot about them in the last 5 years in the business world. Well, I'll mention the others, I guess, because don't want to just disparage a bunch of people, but Iger he's a bit unique, and I wonder about his ego.
I saw someone did like an edit where his book is called Ride of a Lifetime, and they
Oh
were like
yeah,
round trip of a lifetime. That's
yeah.
like it's
That was
perfect.
Ramneek, right? I
Yeah, I
believe.
think so.
Nice friend on Twitter. Good follow. I believe he's still living in India, so very great insights on that market.
Let me. Oh, sorry. Go ahead.
Here is a tweet I put out, or a post, I guess you're supposed to call them now. Still going to call them tweets. All right. This is a double, I believe it's called a pair trade, but honestly, I don't really know the pure definition. I think you'll understand. So here it is. First one, long Amazon, short Shopify, plus long Charter, short Disney. What do you think? Does this outperform?
Don't know Charter well enough. I'm a fan of the first one. The thing that I don't know, like Disney sucks
It's
in my
cheap
opinion,
though. It's pretty cheap right now. Yeah.
but it feels like that's kind of priced in. And the sentiment is, I'm also always wrong on this. Whenever there's a business where I think long term the future is going to be all right, and then all of a sudden the sentiment swings on it, I'm always with the crowd. I'm always like, yep, it's a shit show now. Like Meta,
Yeah,
I was like, yeah, this is uninvestable at the bottom. And so
yeah.
I kind of, maybe I'm my own like contra signal where I just kind of should, check myself in these times of certainty where I think Disney's screwed, and maybe it's a good long-term investment from here.
Yeah, Meta's a good one to learn from, I think, from there. I think it's an example of your sentiment is my opportunity. Maybe to steal the Bezos quote, that can be, for anyone that has high conviction in Disney right now, the sentiment is really poor. And I think if you're right, like, look, I'm pretty bearish on ESPN. I really am. But there's a lot of other people that are. And if you're right, I mean, forward returns could be really, really strong if they start generating consistent cash flow again.
Yeah. The thing is, it's going to, from my view, it's not like the sentiment is just so far off base because of previous financial results. It's going to take, I would imagine, a real shift in strategy and like a change in execution for this thing to work out. So you kind of have to ask yourself, is Bob Iger the right guy to do it?
Yeah.
And that's where I kind of lack belief. Is it felt like he was the right guy over the last decade, but really he left this kind of bag of crap for the successor. And then he kind of comes in trying to act all like a hero. It just doesn't seem, I don't know.
Yeah.
You can see where the cracks were when he left, but you didn't see him while he was there.
Yeah, 100%. And look, this new deal they did with Charter really shows that they're losing their leverage, I think. And it's going to be a tough needle to thread. But we talked about Disney, I think, for like 4 straight shows, even the one that I wasn't on, even though I did listen to that talk with Jason. So maybe we should go to another topic. Here's a question from Tyler. It says, or one more thing, Ryan, you have another thing to add before we switch?
I had a different topic, but let's hit the questions.
Okay. He said, I'm excited for your guys' ad yen coverage. Yeah, we're going to be covering that in 3 weeks. Going to be perfect timing since the stock has kind of collapsed here recently. Have you guys looked into PayPal? Are you going to cover it briefly in the ad yen podcast? I'm sure we're going to talk about that during the competitive section, but we did recently do a not so deep dive on PayPal. Let me try to figure out what month it is so people can figure it out in their podcast player or on YouTube. But I believe it was back in June during our payments month. Yeah, Ryan, any thoughts on PayPal? Yep, June 6th. All right, so everyone just kind of search it through there. You'll find it on June 6th.
Well, I'm a little bit skeptical. I think the threat from the mobile payments providers, so the Apple Pays, the Google Pays, that kind of stuff is a little, some people have dismissed them, but I think it's real. And I think as more people, I mean, it's certainly been, they've been stealing share in terms of transactions. That's kind of no secret. But I think the more people use them at point of sale systems, the more comfortable they're going to feel using them at checkout digitally. So I think they will steal a lot of share from PayPal branded checkout. That's kind of my concern.
Yeah, I mean, Google Pay is so nice, dude. It's so nice. I mean, because especially if you use Chrome for all your browsers, it just automatically updates your card once you put it in for everywhere. And then all you have to do is use your fingerprint or whatever ID you want to use. And boom, you can pay for something.
Well, you're going to have to be an Apple Pay guy now.
No, I actually, what's interesting is if we want to talk about anecdotes on iPhones, I did switch and I do have some anecdotes on that. I would say there's some things that are better, some things that are worse across both, as people might expect. Google Pay, I would say, is significantly better than Apple Pay. Apple Pay was a little clunkier. Google Pay was nicer. I actually re-downloaded Google Pay and I used that instead because specifically when I'm on my other devices, you're on Google Chrome, it updates automatically. But in the end of the day,
you're an iPhone user now.
Yes, that is correct.
You want to give some anecdotes? What do you think? A couple weeks in, you've been on the other side of the war for a while.
Yeah, I know it could give some good perspective. Let's see. One thing that I thought was interesting is they make WhatsApp way worse on iPhones than they do on Android. So I think Meta probably has some gripes on that. And definitely that's because Apple does it on purpose. Other one, the blue messages thing is what like I don't know. I don't understand the hype, but maybe it's because I'm not really. I just use messaging for not much. I don't know. I just use it for information. I'm not much of a messenger.
You message for functionality,
yeah,
not for entertainment.
Yeah, exactly. Other people seem to be quite happy about it, but I don't really get it. But whatever, they seem to be happy, so good for them. Let's see. What other things are better? I mean, I would say I don't like the Face ID thing versus the thumbprint. I like thumbprint much better. I think it's much easier. and the Face ID
I
thing
agree.
kind of like turns on after a
I've been
while.
a, I've been a hater about that for a while.
The new Androids basically have like the thumbprint. It's not like a thing on the back. It's like on the screen. You just push it right in the middle. Way better, I think. It's much easier to see what's better on Android when coming over versus worse, right? Because it's much easier to realize, oh, this is way worse. I'm gonna have to deal with this forever now. But I don't know what's better.
What was the switching process like?
I guess the photos are obviously better, right? With that stuff, they're really
Yeah.
much better at that. The switching process, well, I did lose my phone, so it's way worse. But I know that when you have the other phone, it is easy. They can do that at the store for you, but for me, I did lose everything. So yeah, but the photos are much better, which I think is kind of the key thing Apple focuses on, right? The camera, the cameras are pretty much the same, but people think that the Android ones are worse because they make the images qualities worse when you send them over to an Apple product. But the actual Photos app and all that sort of stuff with sharing and stuff like that is much, much better than an Android. And I think that's probably where Apple succeeds. And that's one of their differentiators, which seems like a simple thing, but I guess people care about that a lot, right? It's probably the most important thing for people's phones.
Okay. Little quick topic switch here. A couple weeks ago, we went and we did the biggest signs of the bubble, like biggest top signals. And it was kind of like really the stupidest things that happened during the bubble. If something were to happen again, like a 2021 situation where pretty much, I don't know if it was really tech specific, but it kind of felt like an everything bubble. What are the signals that you would look for to really feel like, okay, this is irrational exuberance. We need to peel back and make actual changes?
Ooh, are you talking about like a
What
general
would give
bubble
you
or
the
any other bubble? Any bubble?
mm,
Because I mean, you could argue that the AI stuff is a tiny bit of a bubble because
I mean,
there's
something that's going to impact the indexes,
oh,
which
okay.
like where equities really feel like they're in a bubble. Is there anything are there any signals that would really tell you that?
Well, I think one signal that's here today is there's usually a story stock within a bubble or two that are, and this is with the broader bubbles and with the micro bubbles as well, where there's always one story stock that people say you got to buy to get in on this theme. Obviously, that one today is NVIDIA. If you look back at the tech bubble in the 90s, it would have been Cisco and Microsoft and Oracle. And who's the fourth?
Maybe.
Qualcomm. Yep. And then if you look at some of the mini bubbles like cannabis, Tilray, the 3D printing bubble, there was what was that one? That one that is the last part of it is like systems. There was a story stock on the 3D printing bubble, and if we look at some of the other ones, right? What are the other mini bubbles from recent years? Whatever. But yeah, I think a story stock is one of the key points there that kind of gets me nervous today with NVIDIA, but it doesn't seem like that has proliferated to the entire market.
Yeah, that's harder to quantify though. I mean, like, I don't know.
A story stock, I think it's pretty easy to see when there's a story stock.
Yeah, but just like a single story stock does not mean it's widespread. You know what I mean?
Oh yeah, right. It doesn't mean it's widespread. Yeah, that's just one factor I would look for.
Yeah, one of the ones that came to mind for me and probably inspired the question was the sheer number of IPOs in 2021. And I'm sure the sheer number of IPOs in 1999 was very similar, where having that jump that quickly should be a big indicator that capital is too easy to come by for some of these companies. So, I mean, in 2021, I think there was like 1,000 companies that went public, and the year before it was like 100.
Yeah, like I'm trying to get a chart. Oh, okay. Well, this is a table. Hopefully, do they have a chart in here? Yeah, it's just a large paper. But let me read off this table here. If we look at number of IPOs, let's go. Yeah, number here. So let's go 1991 286, 1996, 660, 677. And actually, that was the peak. Then 1997, 474, 1998, 283, 1999, 476, 2000, 380, 2001, 80. Now, if you look at, well, this is going to be distorted
that one might
because
have been harder to
SPACs.
tell.
Well, I think there was other signs that were pretty clear with wasn't the NASDAQ trading at 100 times earnings. If we look at here, it kind of doesn't show the 2021 bubble as clearly because it has 2020, 165, 2021, 311, but wasn't there 1,000 SPACs that went public? So those aren't included here.
Okay, let's rephrase the question then. Let's say you think we are tilting really far towards greed and we're getting tons and tons of IPOs. Valuations feel stretched on the NASDAQ, maybe even the S&P. People are quoting stock as currency. So they're like, well, they can just keep issuing stock and then raise money. What would you change relative to what you did last time, portfolio wise?
Well, definitely I think the way we've thought about it looking forward as kind of a post-mortem of any sort of mistakes is one, if something gets extreme from a valuation perspective, which from our case, it would be like, okay, we bought it at a price we think is pretty reasonable. Like we think it can get 15% returns going forward, blah, blah, blah. But then it goes up 200% in a year or 150%. We would definitely trim a lot of that. I think that's part of our strategy is, okay, look, regardless of the tax hit, regardless of whatever, if the thing gets extreme, we're going to trim. And then second is just focusing on valuation very intensely during that time period, or like trying to buy stuff that is more optically cheap, more maybe value oriented during that time period, because I think that's kind of how you save yourself. We wouldn't, shorting is dangerous during that time period. Just sitting on the cash on the sidelines also seems dangerous, but maybe not today, as you can get 5% on your cash. But
at the time, I mean, you couldn't just say, well, shit's expensive, so I'm going to go. I should probably stop swearing. You can't just say stuff's expensive, so I'm going to go into fixed income at the time, because you're getting literally
nothing.
1%.
Yeah, or less, or yeah, 1%. Yeah, I think that's the key is making sure your portfolio, you don't have to sell out of an entire position, but if something gets extreme, you should probably trim it down. Maybe. Like, I think that's it. And we're not talking about, okay, the stock goes up 50%, sell the whole thing. That's clearly a mistake, especially if you're buying a long-term compounder. But if something is extreme on a valuation front, I think like you can't just be like, oh, I'm just going to pretend like nothing happens. I'm just going to throw a blind eye. My philosophy is never sell. Like, you have to look reality in the face there. What's a good example?
The other thing I don't think we appreciated enough was how correlated the trading would be between a lot of our positions. And I don't know if
that's true.
Like, we just had a ton of tech exposure, and yeah, they're all different businesses, but they all traded really similarly, which I don't know, maybe you could just say, well, if you have a long-term horizon, who cares? But it feels, I don't know, like maybe having different industries and exposure to different, because the purchasing habits are going to be different in those industries. So you might get a little, I don't know, you might be able to capitalize and sell some of your Philip Morris when your match group plummets through the floor, and you can sell some and purchase the other one. Whereas everything we had, or a lot of what we had, was coming down at the same time as everything else. So it was harder to kind of evaluate that opportunity cost.
Yeah. And it takes years to build up the muscle here. And we're still have a goal of kind of building up this muscle. And it doesn't have to be exactly how we're doing it, but I think you can get in trouble if you only target a certain factor, portion, or sector of the market, where a lot of people that are listening to this, individuals, will target technology, consumer technology, and large caps, right?
Even if you're not doing it on purpose.
Yeah. And we did that as well. It's a mistake a lot of early investors make. We have made that mistake. And I think trying to build up a muscle of the one we're kind of trying to target at is micro cap, small cap, deep value. And we're trying to learn how to be better at that. We made, I think, one good investment there, one bad one, or maybe two good and one bad one. We'll see. TBD, right? I think building up those different types of muscles can be very helpful because a lot of the times when, say, large cap, or the easiest example is the most recent in 2021, when these stocks just went crazy. A lot of them are up 100%. The buying opportunities are very terrible. There's nothing really to buy in that industry. You're probably going to want to trim down those positions if you own them. But deep value micro cap and deep value small cap looked pretty attractive if you could find the right opportunities there. So I think having those two, like being very flexible, being able to go after different types of the market or different parts of the market, can be helpful to maybe, if you sell something, okay, I can't just have it sit in cash here, but I can actually go deploy it into something that looks, attractive from a valuation, from a risk reward perspective at the time.
Yeah, I think that makes sense. All right.
Easier said than done, though, where it's taking us multiple years to, it's hard to learn to get better at that. It's not something that you can say, oh, I'm going to buy small caps now, deep value. You really got to learn.
All right. We do have a couple comments from Tyler in the chat. What do you guys see as the future of the media landscape? A complete unbundled streamer world, or bundles of streamers? Will the internet/cable companies own the bundle/customer relationships? Thanks.
No clue.
Beats me.
No idea. That's why I'm not touching the industry. I like video games a bit more, but the traditional media space is tough. Well, I think you could say we like video games more than media. Video games might be a little.
Still don't like them that much, but
yeah.
And I think the longer that we've owned video game businesses, the less we've grown to like, or in my case, the less I've grown to like them. And I think a lot of that is just dealing with the creative talent is difficult. Like, you really have to spend a lot of money to have them. You got to keep them really happy. And there's just a lot of problems that come with that. But on the linear media side, I don't know. It feels unsolvable for me.
Yeah, I don't know what's going to happen. And yeah, we've talked about this a lot. I don't really want to talk about it again because I don't know. And I think that's why you probably need a big discount when looking at some of these companies.
Okay. Do we want to do Mount Rushmore of dumbest acquisitions?
Sure. I didn't write anything down, but
neither did I.
You go first.
Okay. I wish I had more time to prep. I'll take Square with Afterpay. I thought it was really ridiculous.
All right. That's a good first one. I am going to go, and people might, I guess we are talking about Disney again. Disney acquiring Fox.
Yeah, that's a good one.
70 bill, right? 70
and you know
billion.
what's okay? There was a comment about this in the chat. Bob Iger made good acquisitions. But if you make three good acquisitions at $20 billion a piece, and then you blow it on a $70 billion acquisition, I mean, you got it with the acquisitions. I think he kind of ruined his reputation with that Fox acquisition, and he ruined his track record.
Yep. All right. What's your next one?
Man, I'm trying to think of some of the ones from last year where it just, the tie-ups didn't make any sense.
What about FTX? Anything from FTX, right? Or maybe we should say that was just crazy.
Did FTX buy a bunch of stuff?
Oh, yeah.
Oh, I didn't even know that.
They took like a stake in Robinhood, or maybe that was SPF's personal thing. I think they bought Voyager. They got tricked into buying this company called Voyager that was completely bankrupt and a huge liability from a credit perspective, but that could be the wrong name there. Yeah, I mean, they were just on drugs. And honestly, whatever they do, a document that, I'm really hoping that book is good. But
I mean, everything in like on Google is all about like the .com stuff, which I bet the Time Warner AOL one was horrible, but just really wasn't around to know how dumb that was. What's the one AT&T just did
with Time Warner?
Yeah,
it was Time Warner. It wasn't Time Warner AOL. It was AT&T Time Warner. I mean, that one's pretty bad. You want to take that for your second?
I think the the ones where you try to get into a new industry by just making a splashy acquisition, just I would be surprised if there's any examples of those that went really well.
Yep, I would agree. Now, Tyler's taking my second one here, and it is going to be Tidal from Block. I would qualify that as not the largest, incineration of capital. Afterpay
That
is
was
going to be
dumber.
much larger, but
That
Tidal
was
was
dumber than
dumber.
Afterpay.
It's dumber than Afterpay, but obviously it's not going to have as big of an impact on shareholders. All right, what's your third?
Tidal,
I'm
that's a
hoping I
good
got
one.
one as my third that I hope you don't take.
Let's see. Were there any horrible ones from Locker Room, Spotify?
Yeah. That's dumb.
Talk
Yep.
about just chasing the trend. And I think we were too blind to see this for a while.
At least just 50 million. Yeah. At least it was
It was small, but it was dumb.
It was, clearly dumb.
It feels like they always just kind of tried to skate wherever things were popular. Live audio, I'm it's so funny to me that that's just been such a flop. People were saying it's like it's gonna replace social media.
Yeah, that was hilarious. Remember when we were like, okay, let's download the app, see what this is all about, and it was just empty.
It's totally empty. It was
like,
me, you. It was like we were doing like a phone call. It was a little crappy quality, and then some random person hopped in. It was like, "What's going on in here?" I was like, "Okay, this is weird."
Yeah,
that was a bad one. All right.
Here's my third, and you're gonna groan when I take this one. Altria and Jewel.
Yeah, that's a good one.
That was they tricked him. They really tricked him. They knew they had these liabilities coming because they were targeting ads to teenagers with nicotine products, and they dumped a bag on them for $13 billion.
What's the other one that they bought? Kronos.
Yeah. You want to double dip on that one?
Yeah, that one was stupid too.
Okay.
I'm curious if Enjoy will end up that way too. My gut reaction is yes.
Yeah, vaping's such a hard market. Okay. My last one. Did you take that or for Kronos or no?
Yeah, I feel like I'm forgetting about some. Like, I feel like Meta's probably had some bad ones throughout history.
Hot take, Oculus.
Yeah, I mean, that's probably been one of the biggest. Like after the acquisition, it's probably been one of the most wasteful acquisitions.
Yeah, hot take, Oculus. I honestly, I could get behind that. My last one's gonna be the eBay and Microsoft, or actually, well, I would say Microsoft Nokia. It was. Let me see what year that was. When did Microsoft acquire? This is great audio. Nokia. All right, Google. 2014. At least 5 years after the iPhone became popular, they bought Nokia. Are you kidding?
Microsoft did?
Yeah. It was for $7 billion.
And then came the biggest, well, I don't know if this is at the same time, but the biggest hilarious soundbite from Steve Ballmer of no one's going to ever buy the iPhone. No one's ever going to pay for that. Real business is done on the BlackBerry.
Yeah, that's true. Did you watch that BlackBerry movie? I watched it on a plane the other day.
No, I didn't.
Pretty good for investors. Investors would like it. The guy that plays Dennis in Always Sunny is one of the main characters. So
yeah, we've got some comments in the chat. Whole Foods.
No, that was fine. That's fine.
I don't think it was that bad. Yeah. Oh, I guess this wasn't like a corporate tie-up, but Twitter. Yeah, that's got to be one of the most wasteful. Elon buying
it. Yeah. Hey, who knows? The turnaround story's coming. Yeah. No, I think it's clearly at this moment, it's clearly bad. I mean, revenue was down 60%. And what's interesting is that a lot of it was his own fault, I think, but TBD. I think the story's not over with that, but yeah.
Yeah. The interesting part is like, it just feels unmonetizable. I think the subscription business ended up being okay, but I would be surprised if that's really helped that much financially. And he's made a ton of changes, which is what Twitter was unwilling to do prior to him coming in. And it feels like the changes really haven't made that big of a difference.
Yeah.
It's a little bit of like, it's kind of ruining the experience a bit, but whatever. I'll stick with it because everyone's on here. You made a Threads account. Has anything happened over there?
It's pretty empty, but it's because we're starting from scratch, and I literally just made it yesterday. So, dude, this damn light is so it goes crazy. The
Well, the listeners can't see you.
yeah, it just changes. Like I don't know what's up with it, but it's fairly empty, and we made it yesterday. I just made it for the Chit Chat Money account, which again, if anyone's actually on there, go download, follow us, check it out. But seems fine. Like it's pretty bare bones at the moment. But what's interesting is that the products actually work, because a lot of the Twitter stuff is so buggy now. It's very frustrating. So I'd rather have a Threads succeed compared to Twitter, but I think we're going to hedge our bets with both. Yeah.
Okay. All right. Well, I think that concludes most of the Mount Rushmore. What out of the companies we've owned, what's the biggest like? I wish you didn't buy that.
For the years.
Match
Well,
Group, maybe with Hyperconnect.
Oh, acquisitions. Yeah. Yeah. It's hard though. It's just tough timing on that. It didn't seem that crazy at the time, but clearly they were getting caught up in the pandemic bullwhip. I'm trying to think through all the companies. I mean, Autodesk.
You know who went on a
Autodesk
bunch
could
of
have had
buying sprees when we owned them was Wix. They bought a ton of companies.
right a lot of small ones that were like, man, like,
Could work, I guess.
yeah, I'm sure you're paying 30 times sales for this and it's not profitable, but you know what? There's synergies for the e-commerce and payments platform, right? Yeah.
Have you seen all this? I find this kind of funny because on the Wall Street Journal, there's been a lot of coverage about Spotify's wasted money on podcasts. And there was actually a podcast that came out from the Journal podcast, which is co-produced with Gimlet, who is owned by Spotify, about how much money Spotify has wasted.
Yeah.
Which I find kind of interesting. But I did not realize, I don't know, I guess just how careless they were being with some of these efforts. Like telling the teams, do whatever you can to get listens. Don't worry about cost.
Yeah.
It just,
what's interesting is that they're a little bit behind the timeline because they've switched that strategy, say 6 months ago, but obviously there's still going to be a few years of, like it's not going to, they can't just eliminate those costs overnight.
Yeah. I do stand by the fact though, that this Spotify has an operating expense problem, not a cost of revenue problem.
Yeah. What sucks is that like the Bears have been right on Spotify, but for the wrong reasons. Like I always say, I'm like, no, that's not why the stock. It just frustrates me in that regard. But whatever, make money.
There has been, I think that's been probably one of my biggest hiccups over the years in my own stock ownership, where with stocks I own, I'll often see bears with takes that don't make any sense or takes that I disagree with. And I'll think that's wrong. And as if that's justification for continuing to own something that isn't worth owning. Because the opposite side is wrong, so I must be right. It was like Spotify had all these bad bear takes, in my opinion. There were, people saying like they got to own all the content on there, that kind of stuff. They have to be Netflix. I disagreed with all that. But at the end of the day, the problem was they just hired too many people. And they spent too much money when they didn't need to.
Yep. All right. Yeah, I totally agree. No further comments. Anything else? Do you see Amazon?
I got a question here.
Ooh,
do you guys have any thoughts about Amazon trying to dominate the entire end-to-end logistics of third-party commerce?
Tyler was reading my mind because that was exactly what. He said I had a great tweet about it. I did think that was funny. Did you see that? Yeah.
I saw that. Yeah, sorry, I was nodding my head and drinking, so I didn't want the microphone to pick all
Okay,
that
so
up.
here's what the blog post. Just scroll through my tweets and find it. Hopefully, you can't hear me scrolling. All right. So, new product from them that says, here's the headline: Introducing Supply Chain by Amazon, an automated solution to help sellers quickly and reliably ship products around the world. Okay, so I think there's a lot of paragraphs in this blog post, and it's not going to be good audio if I just read it. But basically, they're saying, okay, we're not going to be your manufacturer in Asia and Mexico and the United States, wherever, but we can connect you with that, and we can basically, okay, say you make a contract with this manufacturer in Vietnam. We can manage all of that for you. Take your inventory, manage it as we get it across the ocean. Some of that's going to be on our own stuff. Some of that's going to be on, like a Merc or what are their ships called? Whatever, the giant shippers, whoever those companies are. And we're going to do it for you. And then as we get to the United States, we're going to hop it on our own network. And we're going to basically do end-to-end vertically integration here. And we can manage all of that for you. And they're saying, let's see, what's the stat they had about it being 25% cheaper? Yeah. Okay. So if we look at their Amazon Global Logistics offering, which again, there's a lot of different offerings here, but essentially they're kind of extending further back into the supply chain. So they're going more vertically integrated here. They said their new pricing now reflects a discount of up to 25% on all cross-border transportation that is bound for Amazon warehousing, further reducing costs for selling partners using supply chain by Amazon. They also had another stat here that FBA, which is fulfillment by Amazon, they're more closer to, once they get to the warehouses in the United States, has become a very valuable service for our selling partners, offering a fast and reliable fulfillment service that is, and this is the important part, on average, 70% less expensive than other fulfillment services. So I think what's interesting is they're making it so cheap that this can be a real growing advantage for them, where people can, those costs in the back end are going to be cheaper. So now they can sell on Amazon at a cheaper price, still make a profit. I think that makes it a bit similar to Costco.
It's a beautiful moat.
Yeah. And for anyone that doesn't reference it, the tweet was, give me a shareholder base with a long enough time horizon, and I can vertically integrate the world. I think that kind of sums up what they're trying to do here. What's interesting, I thought they didn't really have much vertical integration left, but they're still really going after it. It's ambitious.
Yeah. They continuously find new ways to kind of expand their infrastructure moat, which would have been. I mean, they are gonna. Oh, I can picture a world where they're shipping everything, and that would be nice.
Would you be surprised if they bought what do they call those? The giant ships? I forget the names on it. The freight liners, the giant ones. Would you be surprised if they bought one of those?
I'm gonna say yeah, just because I would prefer they did it on their own. They've never really done that before, right? In terms of when they build out their fulfillment network, it's never been through acquisition. It's always primarily been through, we're going to build it ourselves.
Oh yeah, no. So no,
I
would
mean
say
like a specific ship?
a little, not a company, but getting a ship. I think that would be I would get a bit nervous about that, but I wouldn't be surprised, right? Because a lot of the stuff's coming from different areas of the world, and you can say, look, you hop on our ship, you're part of the network.
Do they have their own ports?
No, I think that's not going to happen. That would be quite
or
hard.
Maybe even their own subsegment of a port. I don't know. Given how much they process in terms of volume, it wouldn't surprise me if they had their own. There'll be a world with their own ships, their own ports, the own Amazon mailbox. I mean, there is like plans. Amazon mailboxes at these apartment complexes, big apartment complexes now.
Yeah, it's pretty nice. And other shippers use it, but Amazon powers it. Like other shippers can use it, but they're the ones that power the thing. Yeah, I lived in a place that had that before. I mean, people might be like, oh, they're not going to buy a giant ship, but they have a fleet of like 100 planes now, and I don't think it's that crazy to get into that market, although it's a bit more expensive. Yeah, and it's interesting, I'd say it's quite interesting, and it would be so hard to switch off of them now, right, as a supplier. And here's actually, one other thing from this note that I think was important is that they're now allowing you to get managed by Amazon, even if even if those products are not meant to be sold specifically on Amazon. So you can have your inventory, all your supply chain managed by Amazon, but you can have it managed for stuff that's getting sold on your Shopify store, stuff that's going to get sold at your in-person store, and stuff that's going to get sold at your wholesale retailers, and that's going to get sold on Amazon.com. So they're expanding from not, traditionally the stuff was really only available for Amazon.com.
Yeah, I love that. We talked about it, I want to say a year ago, where it's like every time they sacrifice a little bit of margins, that moat just gets wider and wider, and it becomes so hard to compete with them. I would say their moat in shipping and fulfillment is maybe we should do a Mount Rushmore of moats, because I think that might be up there for me.
We've done that before. I think when we used to have Ian and Brad join the show, which for any longtime listeners, we are having Brad Freeman back on for an interview on SoFi coming out next week, which will be very fun. I think we did that before, or maybe it was like just vague and we said best businesses, but we could come back and try to reanalyze best moats. And yeah, I think a little teaser, my number one would be Visa, but I'm a fan of that company.
Yeah, Visa's definitely up there.
They're all going to be good.
I'm reluctant to put anything that's a digital based moat. I'm reluctant to have that be the number one, because I think with Amazon, it's way harder. There could maybe be some way digitally to circumvent Visa or Google's moats, or maybe regulatory problems. But with the physical,
go ahead.
It's like, I don't know if anyone has the money to replicate the physical infrastructure that Amazon has built.
Yeah, no, and clearly it's strong, but maybe this is a tease on what the debate would be, but Visa has got attacked by numerous governments around the world to try to defeat them, and they can't. So
if there was a global coalition, it's possible.
Yeah, if every country in the world decided that, yeah. I actually don't think, I honestly would say, I honestly don't. I don't know if they would win, because how do you even, like, what are you going to do? Get all the cards out of circulation? What are you going to do? You get all this new thing on 200 million merchants? Like,
crypto,
yeah, whatever. Yeah. Okay. I hope, please. Yeah. Let's spread. We need a new, like, crypto obviously isn't going to tank Visa anymore. We need a new narrative that tanks the stock, like buy now, pay later. So I can finally pitch it and we can buy some shares.
Andrew says a moat that requires that much CapEx is such a better moat than a lot of software, in my opinion. I think that's right. With the network on Visa, I think you can make the argument, but yeah, those physical moats to me are such a huge advantage.
Yeah, I can get around that. I definitely see that argument.
The other part is, like, let's say I gave you $300 billion and you can build the infrastructure you want to try to compete with Amazon. It might take more money than that. Even with that money, you have to have the expertise and the logistics prowess to really build a physical network that works. And I just think there's zero chance, if you gave me all the money in the world, that I can make that happen.
Even if you gave it to an ex Amazon executive to copy, like, and plus Amazon's not gonna, like, you could copy what they are today, but it would take you multiple years and then you're still behind them. It's similar to Taiwan Semiconductor. You could argue, excluding geopolitical risk, they're one of the tightest moats, along with Samsung, in the foundry space. Yeah, I mean, that's a good one. We could do a full show really describing all these sort of things. But yeah. Oh, one thing I would say is, did you see that the Flexport, all that Flexport stuff with the Amazon CE or ex-executive, like, leaving, and the whole debate around that?
Oh, I saw that. Yeah, they were firing people after saying that they were hiring them or something.
So, okay, the founder left, brought on an Amazon exec that used to work in kind of a similar space where Flexport is trying to be a supply chain type of company. They really don't know their business model, but then apparently the founder did not like what this guy was doing. So he came back and took over the company, blamed the Amazon guy for a lot of stuff that, mistakes they made. What if this guy was just a mole to feed Flexport? from the start. I honestly,
No.
that's my conspiracy.
Was Flexport the one that did the deal with Shopify? That got spun
Yeah.
out? That
Yeah.
was okay. Oh. Yeah, logistics. I would hate to be an upstart logistics company.
Yeah. All right. Well, I think that's a great way to end it. Thank you for the people joining. Remember, this goes live typically Thursday mornings, 9:30 a.m. Pacific time, 12:30 Eastern. You can watch the replays on YouTube and catch the live chat where we have the questions. You can also listen on your favorite podcast player of choice, Spotify, Apple, Google, wherever. Those come out Sunday mornings. Thank you everyone for listening. For the disclosure here, we are not financial advisors. Anything we say on this show is not formal advice or a recommendation. We're general partners at Arch Capital, and clients may hold securities discussed in this podcast. Thank you everyone again, and we'll see you next